Yep. So there's a lot of background that I think is relevant to what we were discussing, which is related to this session. And so my understanding of Bitcoin, my personal experience was first through technological lens. It was not even through economics. It was just as a fascination of a thing that emerges out of social consensus on computers. It's very, very childish and naive and fascinating, wondrous thing for me that how are we arriving at 21 million without somebody telling us that this is how the rules work and this is how this system works. But this system works because of economic incentives more than anything else. And this series and this concept itself summarizes that. And gradually, then suddenly, not all humans, not all economic participants are ever going to understand what happens under the hood of Bitcoin, but they are going to realize the value of Bitcoin because of the economic incentive that it creates and which is embedded in the system. And there is no exogenous force which can disrupt that, which is going to be the theme of this article, especially because in the context of what is happening in the world right now, there is a massive confusion for most individuals between savings and finance and investing. And for any saving to happen, as boring as that concept sounds, is it's important for an individual to take risk. It's important for them to put themselves out there, put their labor, energy, creativity, and produce something of value so that someone else is willing to part their hard-earned money and give it to you. So saving itself requires humans to take risk. And what the current monetary system has done is that we are forced to take more risks than we have already done to create the value that savings allows us to secure for our future. So there's a lot of things that this article covers, and there's a lot of ancillary things that I think are important for people to be aware about. Because a lot of the times, what I have realized is that most people are simply not aware of central bank monetary policy. They're simply not aware how money itself works. It's not even from a very technological point of view, but just from the point of view that what the purpose of money is, and the second being what is happening in the current monetary system. So this simple information asymmetry being the problem, not some technical concepts. Bitcoin is not quantum mechanics that you need to have some specialized knowledge. You need to understand on a very philosophical level that Bitcoin is representative of fixed supply and money, which has never been possible. And yeah, it allows for something called Great Definancialization, which is the renaissance of Bitcoin. That finally we are able to have one money which nobody can manipulate. And yeah, in the context of what is happening, and this article covers that in a lot of details. Some of and help together understand how a lot of the other financial instruments have been created in the last 2 decades, especially, but also in the last 5 decades, which was the point where humans, or at least the modern history, left the gold standard or the last vestige of hard money in the economy. So yeah, I'll take one small pause because I've been speaking a lot for the last 2 minutes, but we'll start if nobody has any comments, thoughts, questions to share.
No, nothing. So, Shan, we will have two articles that we cover, or just with this one?
So yeah, so this is the final article I'm wanting to cover this because the previous two articles were pretty similar, and I mean they are actually great reads. I read them both today as well, and I would recommend somebody if they can check it out. Bitcoin is one for all. It compares, just to give one brief summary of the article. It compares how all fiat currencies are designed to lose value, and they create this weird barter system of currencies. And Bitcoin, on the other hand, represents one currency to coordinate all economic activity. So this is the value proposition of Bitcoin. It allows humans to get information signals about what's valuable and how to create that, and what somebody will have to give away to get more Bitcoin without any exogenous force. I think this article will cover that in more detail. So somebody can read that, but I think this summary or this last piece of article summarizes the essential concept of this entire article series. So
Perfect.
even if you've not been able to participate or understand, or maybe you missed out on a few sessions, then this article will give a great summary. Yep. Okay, let's start. So the first few paragraphs are pretty interesting and very layman friendly, very intuitive questions that a lot of people do not think generally. So I'll start reading. Have you ever had a financial advisor, or maybe even a parent, tell you that you need to make your money grow? This idea has been so hardwired in the minds of hardworking people all over the world that it has become practically second nature to the very idea of work. The line has been repeated so many times that it is now a de facto part of working culture. Get a salaried position, max out your 401k contribution, maybe your employer matches 3%. Select a few mutual funds with catchy marketing names and watch your money grow. Most folks navigate this path every 2 weeks on autopilot, never questioning the wisdom nor being conscious of the risks. It is just what smart people do. Many now associate the activity with savings, but in reality, financialization has turned retirement savers into perpetual risk takers. And the consequence is that financial investing has become a second full time job for many, if not most. So I'm pretty sure all of us here, even if we don't know the how it works in the US, but even in India, all of us have grown in the education system where we will always told that you will need to invest your money, you will need to understand how to put your money to work. So this is a concept that is just so ingrained in our culture that most people, without even knowing what money is, even bothering to understand it from first principles, will tell you how money should grow and what you should do for that. So, like I said, the key takeaway from for me with this article was that saving itself is a risky exercise. Somebody had to put in some amount of risk to be able to secure wealth. So, any concept of putting money to work requires people to take extra risk. And just because money has been designed to lose value for the last 5 decades or maybe even 10 decades at this point because of the central bank creation, that we are becoming okay with this idea. It's become normalized for people to think that you need to put your money to work or make your money grow, which yeah, it's an absurd phrase in itself. It's like you have to first be able to produce value to get money, and for your money to grow, you need to create more value or invest in some productive activity or take risk, believe in somebody else creating value. So it becomes this extra exercise that all of us are forced to participate in. Yeah, when we could rather have a better money to solve the problem fundamentally. Financialization has been so errantly normalized that the lines between saving, not taking risk, and investing, taking risk, have become blurred to the extent that most people think of the two activities as being one and the same. Believing that financial engineering is a necessary path to a happy retirement might lack common sense, but it is the conventional wisdom. And I think, yeah, financial engineering or yes, there's all kind of catchy names that you can find on YouTube and Twitter. And I think a lot of people have written so many books about uh, getting your way out through financial engineering or through some catchy name. It will be investment or it will be high returns. But nobody generally outside of the Bitcoin community is talking about money itself. There is a community of gold bugs that I'm vaguely aware about, and there's the community of Austin economics, which has like a huge um, correlation with Bitcoin ethics. But other than that, if you go on mainstream finance or economics videos, you will find that the idea itself that money needs to grow is just taken for granted, and nobody, um, yeah, bothers to question that. Over the course of the past several decades, economies everywhere, but particularly those in the developed world, and specifically the United States, have become increasingly financialized. Increased financialization has become the necessary companion to the idea that you must make your money grow. But the idea itself that you must make your money grow only really emerged in the mainstream consciousness as everyone similarly became conditioned to the unfortunate reality that money loses its value over time. Yeah. So I studied Keynesian economics in a couple of semesters in my college, and I think inflation was just mentioned without even defining the concept, almost as if it's assumed that everybody is aware and understands inflation because that's the reality of the monetary system of today. So, in that context, it's important, at least for me, to just make it clear. Austin economics gives that framework that Bitcoin currently cannot be defined as money in the economics definition of money because it's the medium of exchange. So even though if you think that you can opt out of any problems with the monetary system by just using Bitcoin and not touching any fiat currency, you are still always are suffering the consequences because money itself represents the ability to have variety of choices in exchanging the value that you have created with value that somebody else has created. So whenever there is manipulation in money and some and economic participants are losing value, everybody loses value because they are not able to trade with those partners. or they are not able to participate in the same value system. So it's a thing that will of course take decades for people to understand in terms of more and more people adopting Bitcoin. But it's important that whenever somebody is using money which is losing value, even those people who are forced to liquidate their hard money for that currency are still losing value, even if they are not using it as their primary store of value. Yeah, this is the vicious cycle. Money loses value. Need to make money grow. Need financial products to make money grow. Repeat. Yeah. So this is pretty new for me to understand the financial products themselves. But the theme of U.S. economy for the last 2 decades, especially, has been that their economy is dependent on creating more and more financial products, which just represent a claim on some other productive asset. So they are making a promise that somebody else will be able to produce more value than the money that is losing value, because you can't, the default of just saving money is a losing bet. So you are forced to participate because money is losing value, and you are forced to make to give somebody else money, and they promise you that they will be using that to produce more value than than the value which is being lost due to inflation. The extent to which the need even exists is largely a function of money losing its value over time. That is the starting point. And the most unfortunate part is that central banks intentionally engineer this outcome. Most global central banks target the devaluation of their local currencies by approximately 2% per year, and do so by increasing the money supply. How or why is less relevant. It is a reality and there are consequences. Rather than simply being able to save for a rainy day, future retirement funds are invested and put at constant risk, often just as a means to keep up with the very inflation manufactured by central banks. I think I don't know if I did a good job earlier, but I was trying to highlight that most people are simply not aware of this fact, which is it's not even a hidden knowledge. It's the most mainstream economic theory that is taught in colleges, taught by talked about by mainstream media, mainstream politics, and economic policies. Is that local currencies are designed to lose 2% per year by loud and clear facts. It's not a mystery for people to understand. Fractional reserve and some other bond math that goes into how they are monetized is something that most people are not aware, because there are not enough resources or avenues to understand that. But um, inflation and monetary policy that central banks target of 2% per year inflation is a known fact that most people do not realize the consequences of. The demand function is perversely driven by central banks devaluing money to induce such investments. An over financialized economy is the logical conclusion of monetary inflation, and it has induced perpetual risk taking while disincentivizing savings. A system which disincentivizes savings and forces people into a position of risk taking creates instability, and it is neither productive or sustainable. It should be obvious to even the untrained eye, but the overarching force driving the trend towards financialization and financial engineering more broadly is the broken incentive structure of the monetary medium, which underpins all economic activity. At a fundamental level, there is nothing inherently wrong with joint stock companies, bond offerings, or any pooled investment vehicle for that matter. While individual investment vehicles may be structurally flawed, there can be, and often is, value created through pooled investment vehicles and capital allocation functions. Pooled risk isn't the issue, nor is the existence of financial assets. Instead, the fundamental problem is the degree to which economy has become financialized, and that it is increasingly an unintended consequence of otherwise rational responses to a broken and manipulated monetary structure. Yeah. So I hope it's understandable that the financial products itself are never the problem. People engaging voluntarily in the activity of giving their money to someone else for a contract that both individuals are happy with, whether that means that they will return some dividends on the income that they make, or give ownership through some certificate. It's a contract that both individuals are free to get into, but the problem is the extent to which it is happening in the world, and which is a result of broken and manipulated monetary structure, which is the inflation that we talked about. It's not an option for people now to just save, because that's a losing bet by default, losing place to be. Not even a bet. It's the money that you earned, but you are forced to lose value just because you're using that money. What happens when hundreds of millions of market participants come to understand that their money is artificially yet intentionally engineered to lose 2% of its value every year? It is either accept the inevitable decay or try to keep up with inflation by taking incremental risk. And what does that mean? Money must be invested, meaning it must be put at risk of loss. Because monetary debasement never abates, this cycle persists. Essentially, people take risk through their day jobs and then are trained to put any money they do manage to save at risk, just to keep up with inflation, if nothing more. It is the definition of a hamster wheel, run hard just to stay in the same place. It may be insane, but it is present reality, and it is not without consequence. Yeah. Just one quick pause. I hope this part is pretty simple to understand, but yeah, nonetheless very important. So I'll just take one pause in case somebody has any questions, something to share. Yep. Okay, so I'll resume savings versus risk. While the relationship between savings and risk is often misunderstood, risk must be taken in order for any individual to accumulate savings in the first place. Risk comes in the form of investing time and energy in pursuit that others value and must continue to value in order to be paid and continue to be paid. It starts with education, training, and ultimately perfecting a craft over time that others value. That is risk taking, investing time and energy in an attempt to earn a living and to produce value for others, while also implicitly accepting higher degrees of future uncertainty. If successful, it ends with a classroom of students, a product on a shelf, a world class performance, or a full day of hard manual labor or anything else that others value. The risk is taken on the front end with the hope and expectation that someone else will compensate you for your time spent and value delivered. Compensation typically comes in the form of money because money, as an economic good, allows individuals to convert their own value into a wide range of value created by others. In a world in which money is not manipulated, monetary savings would best be described as the difference between the value one has produced for others and the value one has consumed from others. Savings is simply consumption or investment deferred into the future, or said another way, it represents the excess of what one has produced but not yet consumed. That, however, is not the world that exists today. With modern money, there is a fly in the ointment. Yeah. So, one thing that I like to always quote is that humans have become intelligent or have developed scientific temperament since the time that they started asking the question, how much, not how. So, value is a very deeply natural, primitive thing. Even dogs and all other life forms understand value is because we can see empirically that they do things, certain things, and avoid certain things to get somewhere. But what humans are able to do with value is to be able to cooperate at such an extent, or to the degree that humans are able to cooperate in modern reality and modern day life is insane. It's outside of one conscious mind's control or understanding. So money is the tool which allows us to do that, because it allows us to form relationships with strangers that we otherwise wouldn't do, because it allows us to exchange value with them. So it's a very simple math that a sound money will be able to do us, will be able to help us with. That prices will be able to communicate what you need to do in order to get what you desire, which in economic sense means value from others. So you'll know that this is the value that I need to create to be able to get this value. So in that world where prices are signals of free market activity, you value will become a very simple mathematical equation, which is an oversimplification, of course, but it will be by drastic levels easy for humans to know what is valuable and what are the relative price of two services or two goods. So yeah, just to finish off of how this is not being made possible because of modern money and the manipulation that is in design. That is by design. It's not as if it's local to some economic system, but it's the underlying underpinning of all economy in the modern day. Central banks create more and more money, which causes savings to be perpetually devalued. The entire incentive structure of money is manipulated, including the integrity of the scorecard that tracks who has created and consumed what value. Value created today is ensured to purchase less in the future as central banks allocate more units of the currency arbitrarily. Money is intended to store value, not lose value. And with monetary economics engineered by central banks, everyone is unwittingly forced into the position of taking risk as a means to replace savings as it is debased. The unending devaluation of monetary savings forces unwanted and unwarranted risk taking onto those that make up the economy. Rather than simply benefiting from risks already taken, everyone is forced to take incremental risk. Yeah, I'll just read this tweet of what is wrong with financialization. Stocks, of course, are treated as savings devices. So yes, they have moneyness. This is from Nick Carter, and Pierre Rochard replied to that. In my opinion, stocks became a monetary instrument because inflation pushed savers out of USD. Then it pushed them out of CDs, which I think is collateralized debts, and money market funds. Then it pushed them out of bonds. Now the responsible thing to do is to use Microsoft stock and or low cost index funds for saving instead of investing. Yeah. Forcing, I'll actually take one pause here quick. We're about the halfway mark. We've covered about one third of this article. Okay, if no comments or questions, I'll continue. Forcing risk taking on practically all individuals within an economic system is not natural, nor is it fundamental to the functioning of an economy. It is the opposite, and it is detrimental to the stability of the system as a whole. As an economic function, risk taking itself is productive, necessary, and inevitable. The unhealthy part is specifically when individuals are forced into taking risk as a byproduct of central banks manufacturing money to lose value, whether those taking risk are conscious of the cause and effect or not. Risk taking is productive when it is intentional, voluntary, and undertaken in the pursuit of accumulating capital. Yeah. So, yeah, capital in a very layman definition represents property, and in the modern system, it's becoming more and more difficult for any new entrant into the economy to accumulate capital or accumulate property rights. Um, so, so what that does is that it forces them into taking more inadvertent risks that they did not need to do, and it becomes unsustainable for people to take that risk, not just for themselves, but but systemically because it misallocates funds. It's human signal to create more value gets distorted, and it it it, it fundamentally destroys the structure of both the economy and society. While deciphering between productive investment and that which is induced by monetary inflation is inherently gray, you know it when you see it. Productive investment occurs naturally as market participants work to improve their own lives and lives of those around them. The incentives to take risk in a free market already exist. There is nothing to be gained and a lot to lose through central bank intervention. The operation of risk taking becomes counterproductive when it is born more out of a hostage taking situation than it is free will. That should be intuitive, and it is exactly what occurs when investment is induced by monetary debasement. Recognize that 100% of all future investment and consumption, for that matter, comes from savings. Manipulating monetary incentives and specifically creating a disincentive to save merely serves to distort the timing and terms of future investment. Yeah, so any investment or any consumption can only be borne by humans when they can afford to lose any part of their wealth, because that's how they will be able to create higher standards of living and create more valuable services than just which allow us to survive. So for that to happen, humans fundamentally need to be able to save, and in the modern economy, millions and billions of people are do not even have the alternative other than Bitcoin to be able to save their wealth. It forces the hands of savers everywhere and unnecessarily lights a shortened fuse on all monetary savings. It inevitably creates a game of hot potatoes with no one wanting to hold money because it loses value, when the opposite should be true. What kind of investment do you think that world produces rather than having a proper incentive to save? The melting ice cube of central bank currency has induced a cycle of perpetual risk taking, whereby the majority of all saving are almost immediately put back at risk and invested in financial assets, either directly by an individual or indirectly by a deposit taking financial institution. Made worse, the two operations have become so sufficiently confused and conflated that most people consider investments, and particularly those in financial assets, as savings. Yeah. So the modern store of value, or um, the signal in the economy, is through government bonds, which is a financial asset itself. It's a promise by the Treasury of United States that they will borrow money and return a greater amount of value to the holder of that bond. So it's I think the majority of government bonds are purchased by the central bank themselves, but it's a financial asset that is available in the open market for even individuals to buy. And it's fundamentally a financial asset, and it's fundamentally just a promise by somebody else that they will create more value using the value that they have borrowed from you. So yeah, the operations of saving and investment have become synonymous in the modern economy, but it does not have to be that way, because um, people shouldn't be forced to lend out their money to somebody to be able to live a good life, essentially. Without question, investments in financial asset or otherwise are not the equivalent of savings, and there is nothing normal or natural about risk taking induced by central banks, which create a disincentive to save. Anyone with common sense and real world experience understands that. Even still, it doesn't change the fact that money loses its value every year, because it does. And the knowledge of that fact very rationally dictates behavior. Everyone has been forced to accept a manufactured dilemma. The idea that you must make your money grow is one of the greatest lies ever told. It isn't true at all. Central banks have created that false dilemma. The greatest trick that central banks ever pulled was convincing the world that individuals must perpetually take risk just to preserve value already created and saved. It is insane, and the only practical solution is to find a better form of money which eliminates the negative asymmetry inherent to systemic currency debasement. And this goes back to the point that Ravi brought up, and I completely agree that a lot of the discussions that happen on the layer of law and policy making completely miss out the foundational, or the most fundamental problem with how society operates itself, what society in the first place even means. It means that you are able to cooperate with people outside of your immediate circle, because so Lynn Alden put this beautifully, that pre-modern societies which were tribal could have operated just by social favors, just by keeping a tab on which is a good person, who is somebody that everybody has to carry, who is somebody who brings value back. But in any quote unquote society where people are forced to interact with people that they might not know about, that they don't have to know about, it's humanly impossible for them to cooperate with them. Money is the greatest tool that comes to rescue. And any question of governance and legal systems are important only when we are able to come to consensus on what money is. And Bitcoin, for the first time, allows us to have a money which serves the purpose of the person who's holding that money, and not someone else. This is what Bitcoin represents: a better form of money that provides all individuals with a credible path to opt out and get off the hamster wheel. Take a 1 minute pause here. Oh, there are so many messages in the chat. Let me see. Yeah, so I'll take a pause here. I've been talking a lot in this session. Would love to hear from somebody else. Yeah,
Thing too.
it could be
So
anything.
money
It could be out.
by
Early.
J18. I saw it a day or two ago. I think just now you mentioned that.
Yes, the volume is just a little low. If you can,
Oh, because I'm not using a like a earpiece or a headphone. Can you hear me now?
it's better now. It could be better, but yeah, it's definitely better
Okay,
than
just
before.
okay,
Sorry, say something again.
give me a second. Give me a second.
Okay, okay. I'll read the messages until then. So Jayant said, so basically USD loses value, and in parallel, INR is also losing against USD. It's collateral damage. Yes, and I think somebody put it brilliantly that there is a good chance that, especially during the pandemic money printing, all the central banks definitely coordinated to not make it appear that any one currency is losing value to the extent that it did during the 30% money creation in USD, because all central banks had to cooperate for the exchange rate to not signal too much chaos. But yeah. So the last article, Bitcoin is one for all, that I don't think we will be able to cover, is actually exactly about this, that all fiat currencies create this distortion because all of them are manipulated, and it becomes a game of manipulating or exchanging one worthless fiat currency for another. Yeah. Yes, Faisal, I think you were saying. If Faisal has dropped off, we'll wait for him. Until then, I'll continue reading the chat messages. Ravi says, I recall my grandfather was converting INR to dollars way long back. Now I appreciate why, and it was definitely not to do with coin collections. Yeah. Yeah, I think so. Maybe this is off record. I hope that's not an issue for anyone. That I think so. Tether makes this claim that USDT or the stable coins represent a bridge from fiat to Bitcoin, because it's easier to tell a developing country that why you need US dollar, because it's the most liquid asset. It's the currency that people have known throughout their lifetimes. So it makes sense that yeah, some people prefer holding USD over INR, which I think is already a win, because at least they are thinking about a better money than their local currencies. Faisal says, I know many people who still do it, but there is a limit to which you can own it now, and that too you need to furnish a valid reason to own foreign currency. Yep. Yeah.
I'm just to add to that. So basically, because of so many technology advancement, I don't think 10 years ago anyone had the thought even to get it converted, right? There were so many restrictions on geographical locations. But now people have got that technology interface wherein people are able to, translate by one way or the other to get into a different monetary system in some recently did was I recently assessed what all my investments were and how they were kind of managed accordingly, right? So there were a couple of investments which deteriorates like anything. Like if you put anything in FD in India, right, it's almost like you get like almost you're paying 3%. So 10% is your inflation, and you get only 7% of it. So basically, you giving the FD guys percent you're paying to them in some form or shape. So when you realize that kind of a thing, you have to rethink what kind of investments you have made and where do you stand, and do you have like opportunity to rotate somewhere else. And I guess the one is the technology awareness, like understanding the Bitcoin and even other cryptos as well as USDT, etc., what they play as a use case, as well as understanding the economics of it. I think that's where the world has fallen behind in both the cases. Once they get to catch up, I think they will revisit their investment points. So that was the point of my grandfather's also. So he did that because of that. So now I realize that.
Right. Yeah. My personal opinion is that it's definitely a win that people are moving to USDT, even because they're at least, like I said, thinking about moving to a better money. There's another message that I think Ravi put. I used to remember when US dollar was rupees 45 per dollar 10 years ago. US dollar was 60 rupees. Today it is 84, almost 25% devaluation every 10 years. Yeah. I would love to see some comparison between other fiat currencies compared to the USD price over the last 2 decades, which other fiat currencies are getting devalued at this rate. Faisal is back.
I think, yeah, I have been back for quite some time, but what I had to share wasn't very relevant, so I did not interrupt. I think Indian currencies is the best performing currency. If you compare it with our neighbors, at least I believe like India's currency is, because you said that we should have a chart to compare it. I'm sure India's currency is best as compared to the at least the neighboring currency.
Yeah.
Maybe even the Japanese currency, right?
I'm actually not sure. Yeah, I'll have to look
I
into
am
it.
assuming even the Japanese currency, but yeah, we can look into it. I'm assuming better than Japanese and
Yeah, better than Japanese and a couple of other countries. Yes.
yeah, exactly. Pakistan, Sri Lanka, neighboring countries. Bangladesh, I'm not sure. But at least over the past 50, 60 years, 100% better than Bangladesh and the neighboring countries. So most countries in East Asia, you can say, Indian currency has performed better. But that is not a parameter that, like, these countries are not something that you would want to compare your growth with.
And I think there are overall 6 global currencies that get traded. It's only 6. It's the US dollar, pound, euro, the Canadian dollar, I think yen, and I think the Chinese currency, or maybe the Russian currency as well. So it's most currencies are performing horribly. I think India. I don't know. Some people actually make this argument. I have a very superficial understanding of this. This is the caveat that some people say that because India has a lot of productive capital in terms of human labor, especially, that our currency devaluation is not being felt as much compared to places like Latin America or Africa. But yeah, maybe Indian currency. Yeah, I actually have very little research on how it is performing.
Yeah, I'll find that question for you. So I'll probably next time I'll share the insights around it, or probably
Okay.
share it in the chat. Yeah.
Yeah. Thank you, Ravi. Thank you so much. Hi, more people have joined us. I think I did not address Imdab. Hi, Imdab, and Debo Debo Priyo Mukherjee. Yeah. Jayant, are you saying something?
Yeah, so I was thinking, like, as you have indicated, the currency is a kind of a parameter where you could exchange the value. Okay, so even though in the global context, you say that we are a best performing currency in our neighborhood, but still with the current value exchange parameter has kind of tilted on a lower side. So whatever currency we are holding today, with the same currency of some few years back, you could exchange more value.
Yeah.
So that way, basically, I would not say the currency devaluation, but basically I would treat it as a value leakage.
Right. Right. Yeah. I think I've also just personally also felt it. Yeah. Just one example. I remember. So we used to play tennis ball cricket, and it's inflation over the years. I remember buying it at 20 rupees, and now buying it at 60, 65. I don't buy it anymore in the last few years. But just in a matter of maybe half a decade, it went from 20 to 60 rupees. So yeah, I think even if our currency, I don't know. So this is a separate subject that maybe Ravi said we might be able to cover in future. But it's interesting to know if our currency is how is performing compared to global currencies.
I think one of the points that I wanted to mention in here is if you have a currency which is weaker currency, you also have to give far more attractive returns. So you have to have a growing economy to make up for your export dependency. So if your currency is weak, which is basically you have a lot of export dependency, then you have to have a very fast growing economy, because otherwise people will not be like letting go of US dollar treasury investments. You get around 3%, 4%. If you hold dollars, right, it's like holding Bitcoin and getting 0.5% or 0.25%. Like in the absence of Bitcoin, dollar was the gold standard. Like dollar was the best currency out there. So you hold dollar and you get 3% on top of it, which is a good enough number. Like the only reason you will switch that dollar with rupees, which is like depreciating every year as compared to dollars, is if rupees like investing into India gives you far better returns, right? So that's another thing that countries which do not have who do not have the ability to print dollars face. If they're not growing fast, then it's very easy for them to sort of become highly dependent on US. Yeah, that's a point that I just wanted to mention.
Yeah. Quick question. I think when you say that 3% on dollar, that means dollar denominated debt, right? That's the government bonds that US Treasury offers.
Yeah, US Treasury offered. So as a like if you have a lot of money and you're holding dollars, then there are multiple options that you have. You can continue to hold dollars, and earn 3% every year, or you can convert the dollars into INR or yen and do carry trade. You and like make some money. Make like in India, probably if you invest in the markets in INR, you will make 10% a year, 11% a year. You hope that those 11% are more than the depreciation in rupees every year as compared to dollars, and thereby you make more than 3% that you would have made in dollars, right? So as you can very well see, that will mean that any country out apart from US, like if it is seeking investment, if it is seeking dollars into its economy, it has to promise like really fast growth.
Yeah.
Yeah, basically it comes down to the point you highlighted, Shreyan, that people are being pushed out to become a risk taker, because here you are simply sitting and earning 3%, and when you are going out and putting money somewhere else, basically you are taking risk, because what you are saying, that 10% return or 15% return, that is again, it is in the manipulated sector of this financial instruments. So you never know whether it is 10% or minus 30%.
Yeah. Yeah. Yep. I think this is actually a great segue to what we are about to cover, because this actually also goes into details of some of the financialization and the instruments that are there and how they are capped up. Capped up. What I mean by that is that the demand for them wants to speak that it's the supply is more than the demand, or the most extreme rather version of it, that there was a downward pressure on housing market, but just because the credit system can't allow that to happen, otherwise the whole system falls like a house of cards, then you have to prop them up artificially, which happens through QE. And the more QE happens, the more inflation happens, the more you are forced to take risks, and it becomes a self-fulfilling prophecy of chaos that more and more people will be forced out of being able to buy assets. More and more people will be forced to take more inadvertent risks. And yeah, so until there is enough people realizing that the game itself is rigged, then you keep on piling on more and more chaos, more and more economic instability. Yeah. I'll start reading from here, but yeah, like I said, this article is actually, it covers so many concepts that yeah, sometimes it was difficult for me to categorize into what exactly I want to cover. So I'll read for now, but yeah, this. So I'll request everybody to maybe take the session till 9:15, because this is anyway the concluding session, and I want this session to have as many ideas as we can discuss. Okay, I'll start. The Great Financialization. Whether one considers the game to be rigged or simply acknowledges that persistent monetary debasement is a reality, economies all over the world have been forced to adapt to a world in which money loses its value. While the intention is to induce investment and spur growth and aggregate demand, there are always unintended consequences when economic incentives become manipulated by exogenous forces. Even the greatest cynic probably wishes that the world's problems could be solved by printing money, but then again, only kids believe in fairy tales. Rather than print money and have problems magically disappear, the proverbial can has been kicked down the road time and time again. Economies have been structurally and permanently altered as a function of money creation. Now, I think the following passages will actually highlight this, that the entire system is, it's not working for anybody. Even those people who are, I mean, it's working, of course, at the top of the hierarchy for them to financial engineer the entire economy. But because the dollar is forcing people to prop up this housing market and all the financial assets, the demand is artificially being sustained, and it creates this this weird incentive mechanism where people are unnaturally having to take risks. And yeah, so the can that is being kicked down the road every time becomes bigger and bigger. So the more we avoid this restructuring to happen, which the natural free market is wanting to manifest itself with, the bigger the pain will be, because eventually it is going to happen. That's the nature of debt, that eventually you have to pay it back at some point. If you're not able to pay it back, then the thing that you promised is broken, the promise is broken, and the entire system collapses. The Fed might have thought it could print money as a means to induce productive investment, but what it actually produced was malinvestment and a massively over-financialized economy. Economies have become increasingly financialized as a direct result of monetary debasement and the impact that has had in manipulating the cost of credit. One would have to be blind not to see the connection, the necessary cause and effect between a money manufactured to lose its value, a disincentive to hold money, and the rapid expansion of financial assets, including within the credit system. So, yeah, like I was saying, financial assets themselves just represent a claim on some productive stream. So, it's like you have had to produce some income stream for you to be able to get into financial assets. So, it's like you have to first take that risk, put in the time and energy to get those savings in order to even consider buying financial assets, which you are now forced to do because otherwise you are the losing bet because if you just hold money. And when you force yourself to put that money into financial assets, you are again taking the risk that somebody will be producing value, which is outpacing the inflation, and this creates rapid expansion of financial assets. So it massively misallocates funds which could have otherwise been used for productive activities because free will would allow better decisions and better scrutiny to be made than forcing a person to create value out of compulsion. So this is the financial asset chart, and I briefly touched upon it. It's like the global debt. I think it's the uh, entire economy debt which is being represented here, and it's climbed by 42% in the fourth quarter from a decade earlier. This is in December 2020, by the way. Just the notice that this is 4 years ago, and yeah, the total debt in the market is also divided into non-financial corporates, government debt, financial corporate debts, and households, which I believe are just individuals taking credit card loans for buying a house or a car. Banking and wealth management industries have metastasized by this same function. It is like a drug dealer that creates his own market by giving the first hit away for free. Drug dealers create their own demand by getting the addict hooked. That is the Fed and the financialization of the developed world economy via monetary inflation. By manufacturing money to lose value, markets for financial products emerge that otherwise would not. Products have emerged to help people financially engineer their way out of the very hole created by the Fed. The need arises to take risk and to attempt to produce returns to replace what is lost via monetary inflation. This is the net assets of mutual funds in US from 2002 to 2019. This is net assets of ETFs. So more and more money is being forced into financial assets because that's the only store of value when the the thing that is coordinating economic activity is like a hot potato losing value or about to blow up anytime. The financial sector has captured a large percentage of the economy over time because there is greater demand for financial services in a world in which money is constantly impaired. Stocks, corporate bonds, treasuries, sovereign bonds, mutual funds, equity ETFs, bond ETFs, levered ETFs, triple levered ETFs, fractional shares, mortgage backed securities, CDOs, CLOs, CDS, CDX, synthetic CDS, CDX, etc. All of these products represent the financialization of the economy and they become more relevant and in greater demand when the monetary function is broken. Each incremental shift to pool, package, and repackage risk can be tied back to the broken incentive structures inherent to the monetary money underpinning an economy and the manufactured need to make money grow. Again, it is not to say that certain financial products or structures do not create value. Instead, the problem is that the degree to which financial products are utilized and the extent to which risk has been layered on top of risk is large. I'll just read this again. The problem is that the degree to which financial products are utilized and the extent to which risk has been layered on top of risk is largely a function of an intentionally broken monetary incentive structure. Yeah, so the degree to which the point I will reiterate is that the financial products that are promising to create more value, which is being lost due to inflation, become more and more risky over time because people are forced to put more and more investments into them. So it's either more individuals taking more risk or individuals consolidating risk through the use of deposit taking financial institutions like hedge funds and and Wall Street banks, which is like outsourcing the responsibility of risk. So the risk is inherent to the monetary debasement itself, but when you outsource it to another institution, it becomes more and more consolidated because they create all sorts of financial products to justify their own existence and create some redemption for the loss of wealth due to inflation. This is finance and insurance sector in US share of GDP. So more and more percentage of productivity and how that's determined using GDP. So I've had, from my understanding of GDP, I have very fundamental problem with how it is calculated. But I know that one of the factors in its calculation is productivity through capital. That more and more production of capital increases GDP, and we see the percentage of GDP is becoming more and more financial products instead of real goods and services which humans can use. While the vast majority of all market participants have been lulled to sleep as the Fed has normalized its 2% per year inflation target, consider the consequence of that policy over a decade or 2 decades. It represents a compounded 20% and 35% loss of monetary savings over 10 or 20 years, respectively. What would one expect to occur if everyone society-wide were collectively put in a position of needing to recreate or replace 20 to 35% of their savings just to remain in the same place? Yeah. So just to remain in the same place, people are forced to take risks to produce this much more value over 1 and 2 decades. And most people, what they end up opting for is outsourcing that risk and it concentrating in more and more financial products instead of realizing that the money itself is not allowing them to store the value that they have already created. The aggregate impact is massive malinvestment, investment in activities that would not have occurred if people were not forced into a position of taking ill-advised risk merely to replace the expected future loss of current savings. On an individual level, it is the doctor, nurse, engineer, teacher, butcher, grocer, builder, etc., being turned into a financial investor, plowing the majority of their savings into Wall Street financial products that bear risk while perceiving there to be none. Over time, stocks only go up, real estate only goes up, and interest rates only go down. Yeah, that's the theme of how the system sustains itself. It's a slippery, slow slope towards destruction that happens because stocks and real estate are never allowed to go down. So it's a it's more and more people becoming a part of that financial engineering without even their choice. It's like the nurse and the engineer should be able to focus on their specialization, their value addition. But because saving money is going to guarantee losing its purchasing power, you are forced to consolidate more and more wealth into instruments which are just a representation of a promise and not actual value. Yeah, I'll just quickly read this tweet as well. So the author, Parker Lewis, says that for the record, the author is a Dave Portnoy fan, and Dave Portnoy apparently made a tweet: stocks only go up, only losers take profit, which is the conventional, traditional investing paradigm that they look at. Most of them are interested in equity and more traditional financial products than understanding economics from first principles. I'll take a pause here. We have reached the
There was a news recently that there's this showroom. There are these guys who have 2 showrooms in Delhi, and they went and did an IPO, and they got like offers worth 5,400 crore worth of interest was there to buy their stocks. And people were making fun of it, and some people were being rational on Twitter, and they were like, it's okay, that's the kind of interest that is there. Ultimately, they will be subscribed at whatever they are seeking in the market. But like when you are sharing all this, it just so the market does, as in people do recognize the problem which is there with money. They have to find like worthy investments all the time to deploy their money because otherwise it's all going to waste. They just don't know like how they can, and this is the best that they know. Like stock is the best that they know, real estate is the best that they know, which is secure enough, which has legit enough like proof. It's respectable in the community to hold it. And it's also relatively safe in the sense that yeah, again for the same reason that it's accepted means of doing it. I just wish that like Bitcoin would have been easier for them to hold on to. It did not have all those negative connotations that they have, and it did not come with all a lot of baggage like exchanges getting hacked and other crypto getting shilled uh, in the name of Bitcoin. Yeah, I mean that's what my like. I just wanted to make note of that observation. I'll share the interesting story of that stock in the chat.
Thanks. Yep. Yeah, I'll continue reading. So we have approached the half mark. I'll see if we are able to cover. I think we should be able to cover it. Yeah, I might have to just cover it. Yeah, sorry guys. How or why is a mystery to the daily day traders of the world, and it matters not because that's just the way the world is perceived to work, and everyone acts accordingly. Rest assured, it will all end badly. But most individuals have come to believe investments in financial assets are just a better and necessary way to save, which dictates behavior. A diversified portfolio has become so synonymous with savings that it is not perceived to bear risk, nor is it perceived to be a risk-taking activity. Well, that couldn't be further from the truth. The choice is either to take risk via investments or to leave savings in a monetary medium that is sure to purchase less and less in the future. From an actual savings perspective, it is where damned if you do, damned if you don't. It is an unnerving game that everyone is either forced to play or sit it out and lose either way. Consequences of a disincentive to save. Forcing everyone to live in a world in which money loses value creates a negatively reinforcing feedback loop. By eliminating the very possibility of saving money as a winning proposition, it makes all outcomes far more negative in aggregate. Just holding money is a non credible threat when money is engineered to lose its value. People still do it, but it's a losing hand by default. So is perpetual risk taking as a forced substitute to saving. Effectively, all hands become losing hands when one of the options is not winning by saving money. Recall that each individual with money has already taken risk to get it in the first place. A positive incentive to save and not invest is not equivalent to rewarding people for not taking risk. Quite the opposite. It is rewarding people who have already taken risk with the option of merely holding money without the express promise of its purchasing power declining in the future. Yeah. So the only guarantee or promise that is being made to the person is that they are able to hold value in the money that they are holding. And in a system which is designed to lose value, it becomes a duty almost as a rational economic actor to be able to still to secure as much value as you have created over more and more time. And yeah, so any money which is based on sound economic principles will be able to reward people because it's just promising that you will be able to exchange it for value in future. The only utility of money. In a free market, money might increase or decrease in value over a particular time horizon, but guaranteeing that money loses value creates an extreme negative outcome where the majority of participants within an economy lack actual savings. Because money loses its value, opportunity cost is often believed to be a one-way street. Spend your money now because it is going to purchase less tomorrow. The very idea of holding cash, formerly known as saving, has been conditioned in mainstream financial circles to be a near crazy proposition, and as everyone knows that money loses its value. How crazy is that? Well, money is intended to store value. No one wants to hold it because the predominant currencies used today do the opposite. Rather than seek out a better form of money, everyone just invests instead. Yeah, I think it's also just my opinion that it's the inertia of culture that somebody like Ray Dalio, just because he has been successful and one of the famous proponents of macroeconomics, but he does make claims like this instead of just highlighting the fundamental problem with money. I still think that cash is trash relative to other alternatives, particularly those that will retain their value or increase their value during reflationary periods. So there's in my opinion, a financializing hobby that people pick up, and sometimes they might not remember to point out that fundamentally this should not have been a this difficult to understand endeavor or subject. Just my quick opinion. I'll continue reading. Even the most revered Wall Street investors are susceptible to getting caught up in the madness and can act a fool. Risk taking for inflation's sake is no better than buying lottery tickets, but that is the consequence of creating a disincentive to save. Economic opportunity cost becomes harder to measure and evaluate when monetary incentives are broken. Today, decisions are rationalized because of broken incentives. Investment decisions are made and financial assets are often purchased merely because the dollar is expected to lose its value. But the consequence extends far beyond savings and investment. Every economic decision point becomes impaired when money is not fulfilling its intended purpose of storing value. All spending versus savings decisions, including day-to-day consumption, become negatively biased when money loses its value on a persistent basis. By reintroducing a more explicit opportunity cost to spending money, that is an incentive to save, everyone's risk calculus necessarily changes. Every economic decision becomes sharper when money is fulfilling its proper function of storing value. When a monetary medium is credibly expected to maintain value at minimum, if not increase in value, every spend versus save decision becomes more focused, ultimately informed by a better aligned incentive structure. I think my summary of what this passage, the last two passage talk about, is that more and more savers make more and more spenders, because as you have more and more people trying to get your Bitcoin, and because they will be forced to create value for you, and because you don't want to part with your Bitcoin, so you will be forced to create value yourself for someone else or maybe the same person. And yeah, it's like both of you are trying to attack each other by creating more and more value, because everybody is incentivized to save, and the only way to save more is to have someone else spend, and that someone else will spend on a hard money standard only when they get the same value or greater value by parting away with their Bitcoin. That they in their value assessment is the same as parting away with their Bitcoin. One of the greatest mistakes is to judge policies and programs by their intentions rather than their results. This is by Milton Friedman, and I think this is the greatest summary of the economic policy by Austin Economics, which is that socialism might not actually always come from bad intentions, but it does lead to bad results. And this is the lesson of economic history that more and more people need to wake up to. It is a world that Keynesian economists fear, believing that investments will not be made if an incentive to save exists. The flawed theory goes that if people are incentivized to hoard money, no one will ever spend money, and investments deemed necessary will not be made. If no one spends money and risk taking investments are not made, unemployment will rise. It truly is economic theory reserved for the classroom, while counterintuitive to the Keynesian, risk will be taken in a world in which savings are incentivized. Yeah. Indeed, it is also true that risk can only be taken if savings are incentivized, because it's only when somebody can afford to lose something that they can actually take the risk of losing that. Not only that, the quality of investment will actually be greater as both consumption and investment benefit from undistorted price signals, and with the opportunity cost of money being more clearly priced by a free market. Yeah, so consumption and investment, of course, benefit from undistorted price signals. Current housing market is not allowing to signal to the market that there is more supply of houses than there is demand, because it's being propped up artificially to be able to create more and more debt in the system. So it already distorts the price signals for one of the most fundamental needs of humans, which is shelter and housing. And yeah, with opportunity cost of money being more clearly priced by a free market, it makes for better decisions and overall better quality of life. When all spending decisions are evaluated against an expectation of potentially greater purchasing power in the future rather than less, investments will be steered towards the most productive activities, and day-to-day consumption will be filtered with greater scrutiny. So we have about 5 minutes left. So I don't think we'll be able to cover the entire article. So my apologies for not completing this faster. But what I think we can do is,
Summarize it because I think
yes,
you
I
have
think
done
it's,
a good job. We can maybe summarize it.
I am not going to listen to this book next week.
yeah, I think I'm trying to find the one of the last few passages just to close off before I give my conclusion of this, because I think
The sailor's tweet.
yeah.
We can.
I actually wanted the cycle of great definancialization to be covered briefly. That yeah, as more and more people are forced to sell their legacy monetary asset into Bitcoin because yeah, there's more and more negative yielding debt, which is the most until recently most recognized store of value, which is U.S. Treasury, that it becomes negative yielding over the 10-year horizon that it's supposed to capture value. So yeah, more and more of wealth you moving into Bitcoin will pressure those same asset prices to go down, which impairs the whole credit-based system because you'll not be able to take more debt because your asset prices do not support that. The credit system attempts to contract as a consequence, and when it attempts to contract, because there are not even dollars to even pay off that credit, then yeah, it starts off the QE monetary policy by the central bank to prevent the exact same phenomena because more and more debt is the only solution when you can't pay off the debt. And printing money then creates the same loop, and yeah, gradually then suddenly is the overarching theme of the article series as well, that this is how Bitcoin adoption, with every explosion of mainstream financial institutions, with every crisis in the economy, becomes closer to the acceleration of this phenomena, and eventually enough people will be able to realize it by hard reality that Bitcoin is the only way to preserve their wealth, which they have already created. And yeah, so I'll just read Sailor's Bond to finish this off. Thank you so much for um, yeah, helping me not being able to complete this article in one session. So this is the tweet. Stocks, bonds, and real estate are all fiat instruments that derive their value from the future stream of cash flows, discounted by the rate of monetary expansion plus risk premium. They all fail as a store of value unless they can grow cash flows faster than the Fed can print money. So yeah, so unless there is enough productivity for a company to be able to outpace not only competition, not only uh, price signals, but also just the fact that there is more inflation than the last financial crisis because the Fed had to print money to prop up the housing market artificially over and over again. Yeah, we'll just take one pause. So yeah, I think we'll have to finish it off. We've reached the 9:15 mark. I think it's wise to wrap it up. And yeah, if somebody has something to share, unless not, then I'll read the final passage and maybe we can close off the stream then. I'll read this quickly. The difference between saving in Bitcoin, not taking risk, and financial investing, taking risk, is night and day. There is something cathartic about saving in a form of money that works in your favor rather than against it. It is akin to a massive weight being lifted off your shoulder that you did not even know existed. It might not be apparent immediately, but over time, saving in a form of money with proper incentives ultimately allows one to think and worry about money less rather than obsess over it. Imagine a world in which billions of people, all using a common currency, can focus more on creating value for those around them rather than worrying about making money and financial investing. What that future looks like exactly, no one knows, but Bitcoin will definancialize the economy and it will do, no doubt, be a renaissance. Yeah. Thank you, guys.